What if the calm surface of our banking system is hiding cracks as deep as those that led to the 2008 collapse? Banks are failing quietly, not with headlines or panic on every corner, but in ways most people never see until it's too late. Rising risks, hidden losses, and fragile foundations are reshaping the system while the public goes about daily life unaware. Economist Richard Wolff warns that these signs are not random, they are signals of something bigger. Stay with me as we uncover 10 reasons why banks are struggling again and why it matters for your future. Number one, rising interest rates. When central banks raise interest rates, the ripple effects are immediate and far reaching. Suddenly, loans that once felt manageable turn into heavy financial burdens. For families, that might mean mortgage payments that jump hundreds of dollars overnight. For businesses, it can translate into higher costs to borrow for expansion, payroll, or even survival during slow months. The heart of the issue is that banks are directly tied to this shift. Their lending portfolios, which once seemed profitable, start to look risky because borrowers are stretched thin. Many companies are postponing investments, households are cutting spending, and demand for credit slows down sharply. That creates a cycle where banks not only make fewer loans, but also face more defaults on the loans already issued. To grasp the scale of this problem, imagine a small business that borrowed at 3% interest before the rate hikes. That same business may now face refinancing at 7% or 8%, doubling the cost of debt service. For banks, this is a double-edged sword. On paper, higher rates should mean greater profits because they can charge more on loans. But the reality is harsher. Fewer borrowers can afford those loans, and more borrowers are at risk of falling behind. Rising defaults create stress on bank balance sheets, forcing them to set aside extra reserves for potential losses. Those reserves eat into profits, shaking investor confidence and pushing bank stocks downward. Even though the general public might not notice these shifts immediately, economists like Richard Wolff emphasize that these are the cracks forming quietly under the surface. What makes this situation even more precarious is how interconnected banks are. When one bank tightens lending due to rising risks, others follow, amplifying the slowdown. It doesn't just hurt borrowers, it reverberates across entire economies. Job creation stalls, housing markets cool, and consumer spending shrinks, all of which reduce overall growth. Historically, periods of steep interest rate increases have coincided with financial instability. The 1980s savings and loan crisis and the 2008 housing crash both carried elements of this dynamic. Today, with debt levels higher than ever and economies already stretched by inflation, banks find themselves squeezed in the middle. Rising interest rates, meant to tame inflation, are quietly weakening the very financial institutions expected to keep the economy stable. This is why observers warn that the signs of strain we're seeing today may be only the beginning.
Number two, falling commercial real estate values. Across cities worldwide, office towers that once buzzed with activity now stand half empty. The pandemic accelerated a massive shift toward remote and hybrid work, and many companies never returned to pre-2020 office needs. Empty floors translate into lost rental income, and when rents disappear, property values fall. Commercial real estate depends on steady cash flow, And without it, valuations drop sharply. For banks, this is a direct hit. They hold billions in loans backed by these office buildings, shopping centers, and hotels. When the collateral loses value, the security behind those loans weakens. Even if tenants return slowly, many landlords are struggling to refinance at today's higher interest rates, which compounds the problem. What looked like a safe bet a decade ago now looks like a potential liability. Imagine a bank that financed a downtown skyscraper when demand for office space was soaring. At that time, the building may have been valued at $500 million with steady tenants. Fast forward to today, and that same property could be worth far less if occupancy drops to half capacity. The rent collected cannot cover the original loan terms, leaving landlords in default and banks scrambling. Unlike residential housing, where demand is fairly constant, commercial spaces can remain vacant for years. This means losses can drag on for long stretches, draining bank resources. Worse still, smaller regional banks often hold a larger share of commercial real estate loans compared to larger institutions. That makes them especially vulnerable if property owners stop making payments. The headlines may highlight national banks, but often it is community and mid-sized banks carrying the heaviest exposure. The danger goes beyond landlords and lenders. Local economies suffer when large buildings sit empty. Cities collect less in property taxes, nearby businesses lose foot traffic, and the sense of economic decline feeds uncertainty. For banks, the financial strain builds quietly. They may avoid acknowledging losses until they become impossible to hide, hoping market conditions improve. Yet if interest rates remain high and companies continue reducing office space, the outlook for commercial real estate remains bleak. Richard Wolff and other economists argue that this issue represents a ticking time bomb. The combination of falling property values, rising refinancing costs, and weakened demand places banks in a precarious position. What begins as a real estate problem can quickly morph into a financial stability crisis, echoing the chain reactions seen in past downturns.
Number 3, over-leveraged debt. Debt can fuel growth, but when taken too far, it becomes a trap. Over the past decade, both households and corporations have loaded up on cheap loans while interest rates were historically low. Banks encouraged this borrowing spree, expanding their loan books and appearing profitable on paper. The problem now is that much of this debt was issued under the assumption that rates would stay low indefinitely. With the cost of borrowing rising sharply, many borrowers are discovering that they are in over their heads. A household that borrowed heavily to buy a home or finance education is suddenly juggling payments that eat up a larger share of income. Businesses that took loans for expansion face the same squeeze. When borrowers are stretched thin, the risk of missed payments grows, and banks carry that risk directly on their balance sheets. Consider a corporation that borrowed billions to buy back its own stock, a practice common in recent years. When debt was cheap, this strategy looked like financial genius. But now, refinancing that debt costs significantly more, and profits are shrinking. This leaves the company struggling to maintain both operations and repayments. For banks, such situations pile up, creating exposure across multiple industries. If one or two borrowers default, the system can absorb the shock. But when defaults spread, they form a chain reaction. Over-leveraging magnifies every downturn, turning what could have been a mild slowdown into a financial crisis. The issue is not just the size of the debt, but the fragility it creates in the entire system. Every weak link becomes a potential breaking point. The banking sector's dependence on this cycle of borrowing is what makes it so dangerous. Banks thrive when money flows easily, but they falter when too many loans sour at once. Over-leveraged debt ensures that a wave of failures is not only possible, but increasingly likely as economic conditions tighten. Economists warn that debt-fueled growth is unsustainable because it rests on shaky foundations. If enough borrowers fail simultaneously, banks will be forced to absorb massive losses, cut lending, and retreat into survival mode. This contraction only worsens the economic slowdown, feeding into a vicious loop. Richard Wolff highlights that such patterns are not accidents. They are features of a system built to prioritize short-term profits over long-term stability. Today's overleveraging is tomorrow's banking crisis, waiting. Number 4, hidden losses in bonds. At the heart of many banks' balance sheets lie government and corporate bonds, traditionally considered safe investments. Yet the safety of these assets depends heavily on interest rate conditions. When rates rise, the market value of older bonds with lower yields falls. This creates a problem that is both subtle and dangerous. Banks can continue to hold these bonds until maturity, but if they are forced to sell early to raise cash, they must accept steep losses. On paper, many of these losses remain unrealized, meaning they are not immediately visible to the public. However, the risk does not disappear. It sits quietly in the background, waiting for the moment when liquidity pressures force banks to confront the true value of what they hold. This is why economists describe bond portfolios as ticking time bombs during periods of rapid rate hikes. Imagine buying a bond that pays 2% interest annually when rates are low. A few years later, new bonds in the market pay 5%. No investor wants your 2% bond unless you sell it at a discount. For individuals, this might mean a small personal loss, but for banks holding billions in such assets, the impact is enormous. If depositors withdraw money in large volumes, as they often do when economic uncertainty rises, banks may need to sell these bonds at a discount to meet cash demands. Suddenly, those unrealized losses turn very real, eating into capital and shaking market confidence. This is exactly what happened in high-profile cases like the collapse of Silicon Valley Bank, where hidden bond losses became impossible to ignore once withdrawals surged. The danger lies in how widespread this issue is across the financial system. Many banks hold large bond portfolios under the assumption they will provide stability. Yet these very holdings are now sources of vulnerability. While regulators and bank executives often reassure the public that these losses are manageable, history shows that such reassurances can collapse overnight under market stress. Richard Wolff emphasizes that the system encourages short-term thinking. Banks chase quick profits without accounting for long-term risks, and when conditions change, they scramble to cover holes. Hidden bond losses reveal just how fragile even safe investments can be. The quiet erosion of value beneath the surface may not spark headlines every day, but it represents one of the clearest signs that banks are facing deeper troubles than they admit. Number 5, shadow banking risks. Beyond the walls of traditional banks lies a sprawling network of financial institutions, often referred to as the shadow banking system. This includes hedge funds, private equity firms, and money market funds, all of which engage in lending and borrowing, but operate outside the full scope of regulatory oversight. On the surface, these institutions can appear efficient and innovative, offering credit where regular banks may hesitate, yet the very fact that they are not subject to the same rules makes them both opaque and risky. Banks themselves are intertwined with this system, often lending to or investing in shadow entities. When trouble hits the shadow sector, the effects quickly spill back into the regulated banking world. What looks like a problem on the sidelines can in reality be a direct threat to the stability of mainstream finance. To understand the danger, imagine a hedge fund borrowing heavily from banks to make bets on risky assets. As long as markets rise, the arrangement works. But if asset prices fall, the fund may not be able to repay its loans, leaving the bank exposed. These relationships are not always clear to outsiders, and even regulators may struggle to see the full picture until it is too late. During the 2008 financial crisis, many of the most catastrophic failures stemmed from shadow banking activities like securitization and derivatives trading. The lesson was supposed to be that hidden leverage creates systemic risk. Yet despite reforms, much of the same activity continues today under different forms. With higher interest rates and volatile markets, the chance of cracks forming in the shadow system grows larger every day. The challenge with shadow banking is that it magnifies risk while concealing it from public view. Traditional banks must publish balance sheets, but shadow institutions operate in greater secrecy, making it difficult to measure just how fragile they are. If one of these entities collapses, the domino effect can spread rapidly because of how interconnected modern finance has become. Richard Wolff and other economists argue that this lack of transparency is not an accident, but a feature of a system designed to chase profits at all costs. For everyday people, this means that crises can erupt suddenly, seemingly out of nowhere. The banks may appear steady, but their ties to the shadow system make them far more vulnerable than they admit. The quiet risks of shadow banking represent one of the most underestimated threats to financial stability today. Number 6, lack of public confidence. Banks rely on one thing above all else: the belief that depositors' money is safe. Yet history shows that when this confidence cracks, even the strongest institutions can unravel overnight. A bank might hold billions in assets, but if too many customers withdraw their deposits at the same time, the institution can collapse in a matter of days. This is what is known as a bank run, and it happens not because the bank's numbers are immediately catastrophic, but because people believe trouble is coming. Once the rumor starts, fear spreads quickly. Even those who were not worried initially decide to withdraw just in case, creating a self-fulfilling prophecy. In a digital age, this fear travels even faster, as withdrawals can be made with a tap on a phone rather than standing in long lines outside. Picture a family hearing on social media that their local bank might be in trouble. They rush to transfer their savings elsewhere. Hundreds of other families do the same, and within hours, the bank's liquidity is drained. The underlying issue may have been manageable, like unrealized bond losses or temporary debt stress, but public panic amplifies it into a crisis. This dynamic played out in 2023 with institutions like Silicon Valley Bank bank, where whispers of instability triggered mass withdrawals before regulators could intervene. Economists stress that such events demonstrate how fragile the system is when it depends so heavily on perception. A healthy banking system requires not only sound financial practices, but also steady public confidence, and once that confidence is shaken, recovery is extremely difficult. The erosion of confidence is not limited to isolated bank failures. Broader skepticism grows when people see repeated patterns of instability, bailouts, and inequality in the financial system. Many wonder whether their deposits are safe or whether they are merely funding risky bets made by bankers chasing short-term profits. Richard Wolff often emphasizes that this cycle of panic reflects deeper flaws in the system itself. If banks need constant reassurance and government backstops to maintain credibility, can they really be considered stable? Public confidence is like oxygen for the financial system, invisible when present but deadly when removed. The quiet unease that spreads each time instability surfaces suggests that the foundation of trust holding banks together is far weaker than many realize. Number 7. Concentration of wealth in mega banks. Over the past few decades, a striking shift has occurred in the financial landscape. Deposits and assets have been steadily flowing from small and regional banks into the hands of a few mega institutions. This concentration of wealth creates an illusion of strength, but in reality, it breeds fragility. Smaller banks often serve local businesses and communities, providing the type of personalized lending that large institutions avoid. When those smaller banks lose deposits, they struggle to survive, while the mega banks grow even larger and more powerful. The result is a financial system dominated by a handful of players whose decisions carry enormous consequences for the economy as a whole. If one of these giants stumbles, the damage is far greater than the failure of dozens of smaller banks combined. Consider how this played out during recent banking scares. When regional banks faced instability, depositors rushed to transfer funds into larger institutions, believing them to be safer. On the surface, this seems rational, but it accelerates the decline of smaller banks, further shrinking competition. Communities that once depended on local banks for small business loans now find themselves overlooked by mega institutions focused on bigger, more profitable clients. This dynamic also concentrates the financial system is like a table supported by many legs. If one leg breaks, the table can wobble but remain standing. When most of the weight is shifted onto just a few legs, the collapse of even one can bring down the entire table. Mega banks may appear too big to fail, but history shows that no institution is immune when systemic stress builds. Richard Wolff often highlights that this consolidation reflects deeper systemic priorities, profit maximization and deregulation rather than stability or community support. With power concentrated in fewer hands, accountability diminishes. Regulators become hesitant to challenge mega banks because their collapse would endanger the whole economy, creating a cycle where the biggest players are shielded from consequences, while smaller banks are left to sink. For ordinary depositors, this shift means less choice, less access to tailored financial support, and greater vulnerability if a major institution falters. The concentration of wealth in mega banks may look like strength on the surface, but beneath it lies a dangerous imbalance that magnifies systemic risk. When so much depends on so few institutions, the financial system becomes more brittle, not more secure. Number 8, weak regulatory oversight. Regulation is meant to serve as the guardrail of the financial system, preventing reckless practices from turning into full-blown crises. Yet history shows that these guardrails often weaken just when they are needed most. Banks have lobbied aggressively for looser oversight, arguing that excessive rules stifle innovation and profitability. Over time, this has led to a patchwork of regulations filled with exemptions and loopholes. The result is a system where banks can engage in riskier behavior with fewer checks in place to stop them. While regulators claim to monitor financial health, their actions are often reactive rather than proactive. By the time warning signs appear in the data, the underlying damage is already done. This pattern is one of the key reasons Richard Wolff and others argue that recurring crises are built into the system itself. One striking example is the rollback of parts of the Dodd-Frank Act in the United States, a law originally designed to prevent another 2008-style meltdown. In 2018, certain requirements for mid-sized banks were relaxed, allowing them to avoid stricter stress tests and capital requirements. Not long after, some of these very institutions found themselves under strain when interest rates rose and asset values fell. The lesson is clear. When oversight is weakened, vulnerabilities grow silently until they erupt. Even at the global level, regulatory bodies face similar challenges. Financial markets evolve faster than the rules designed to contain them, with innovations like complex derivatives and digital assets often slipping through traditional frameworks. Without robust oversight, banks can take risks that look profitable in the short term, but leave them exposed to massive losses in the long run. For the public, weak regulation means greater exposure to instability that they cannot control. Ordinary depositors and small businesses depend on the assumption that their banks are being watched carefully. Yet the reality is far less reassuring. Regulators often walk a fine line between protecting stability and accommodating powerful financial interests. This creates a cycle where enforcement is inconsistent and systemic risks are allowed to grow unchecked. Richard Wolff underscores that regulation in its current form does not eliminate crises. It merely delays or disguises them. The banking system becomes a game of cat and mouse, with regulators always a step behind. Weak oversight ensures that problems are not addressed at their root, leaving society vulnerable to another round of sudden and painful financial shocks. Number 9, global instability. Banks do not operate in isolation. They are deeply tied to the global economy. Wars, trade disputes, pandemics, and supply chain breakdowns all ripple through financial markets, creating volatility that strains banking systems. For instance, conflicts in energy-producing regions drive up oil and gas prices, which in turn fuel inflation. Central banks respond with rate hikes, and suddenly banks find themselves facing both higher borrowing costs and growing loan defaults. Similarly, global supply chain disruptions leave businesses unable to secure goods, forcing some into bankruptcy and others into costly delays. Each of these events, while starting outside the banking sector, eventually lands on banks' balance sheets. The message is clear: instability abroad often translates into financial stress at home. To see this more vividly, consider how European banks were affected by the war in Ukraine. Rising energy prices not only strained households, but also devastated industries reliant on cheap energy. Banks with large exposure to those companies suddenly faced higher risks of loan defaults. Meanwhile, international sanctions reshaped trade routes, forcing financial institutions to adjust quickly or lose money. The interconnected nature of global finance means that a crisis in one part of the world rarely stays contained. American banks with investments overseas or ties to global supply chains also felt the impact. What starts as a geopolitical conflict can quickly morph into a banking challenge, showing how fragile the web of global finance has become. This fragility extends into emerging markets, where debt levels have surged and currencies remain vulnerable to fluctuations in the US dollar. When the dollar strengthens, it becomes harder for these countries to service dollar-denominated debt, putting pressure on local banks and, by extension, international lenders. Richard Wolff often points out that globalization has not created stability, but rather a system where crises can spread faster than ever before. A financial shock in Asia, political unrest in Africa, or a recession in Europe can all trigger ripple effects that land on U.S. banks. For ordinary people, the global nature of banking means that even distant events can affect the security of their savings and the stability of their jobs. Global instability ensures that banks remain perpetually exposed to risks beyond their control, making the system not only interconnected but also dangerously interdependent. Number 10, growing inequality and economic fragility. Banks function best in an economy where a strong middle class can borrow, spend, and repay loans consistently. Yet growing inequality is eroding this foundation. Wages for many workers have stagnated, while the cost of essentials like housing, health care, and education has soared. As a result, households take on more debt simply to maintain their standard of living. This increases their vulnerability to shocks, whether it's a job loss, medical emergency, or interest rate hike. From the bank's perspective, these households become riskier borrowers, raising the chances of default. On the other end of the spectrum, wealth is increasingly concentrated among the top earners, who are less likely to borrow heavily. This creates an imbalance. Banks are left with fewer safe borrowers and more fragile ones, a recipe for instability over time. Consider how credit card debt has surged as families struggle to cover everyday expenses. These balances often carry high interest rates, which compound quickly and trap people in cycles of repayment. When large numbers of consumers fall behind, banks feel the strain. The same dynamic plays out with student loans, auto loans, and mortgages. Rising inequality means fewer households are building wealth through homeownership or savings, which historically provided a buffer against downturns. Instead, many live paycheck to paycheck, leaving them unable to absorb even small financial shocks. When so many borrowers are stretched thin, banks cannot rely on steady repayments, making their own position more precarious. This fragility spreads across the financial system, amplifying risks that might otherwise have been manageable. Richard Wolff emphasizes that this growing inequality is not just a social problem, but a structural weakness in the banking system itself. A healthy economy requires broad participation, yet today's wealth concentration undermines stability. The financial sector depends on widespread consumption and borrowing, but when only a small elite thrives, the cycle falters. Banks may continue to show profits in the short term, but the foundation beneath them is weakening. As more households fall behind, the system becomes increasingly unstable, setting the stage for the next crisis. The link between inequality and banking fragility is often overlooked, but it may be one of the most important reasons to watch the system closely. Inequality ensures that banks are not just exposed to financial risks, but also to the deepest social imbalances that make those risks harder to contain. The picture becomes clear when all 10 reasons are placed side by side. Rising interest rates, falling real estate values, over-leveraged debt, and hidden bond losses show how fragile banks are beneath the surface. Add in shadow banking risks, shaken public confidence, the dominance of mega banks, weak oversight, global instability, and widening inequality, and you see a system stretched to its limits. Each factor alone would be concerning, but together they form a web of vulnerabilities that cannot be ignored. What Richard Wolff emphasizes that these issues are not isolated accidents. They are symptoms of a financial structure designed around short-term profit rather than long-term stability. Banks may project strength in public reports, but behind the numbers, the cracks are widening. Quiet failures today can become loud crises tomorrow, and by then it may be too late for most people to prepare. For everyday families, this isn't just an abstract discussion about Wall Street or economic theory. It's about whether your savings remain secure, whether your community has access to credit, and whether the next downturn will erode opportunities even further. The signs of strain are already here, and ignoring them won't make them disappear. If this breakdown opened your eyes, hit the like button, subscribe for more insights, and share your perspective in the comments. Do you believe banks are truly stable, or are we heading toward another crisis? Your voice matters, and continuing this conversation is the first step to real awareness.